Welcome back to the deep dive. Today we're looking at just one really potent piece of trading wisdom.
Yeah, this one comes from Mansi.
That's right, and it goes, bulls make money, bears make money, pigs get slaughtered.
It's punchy. Definitely memorable.
It really is. So our mission today is simple. Let's unpack that. What does it actually mean for anyone, looking at the markets?
Absolutely. It cuts right to some core ideas about, well, market behavior and our own psychology, really.
Okay, so let's start with the basics. Bulls and bears.
Right. So bulls, they're the optimists. They trade thinking the price of something, a stock, whatever is going up. They buy low, hope to sell high. Pretty straightforward.
And the bears.
Bears are the opposite. They
Yeah.
anticipate prices are going to fall. They make money from that decline, maybe through short selling, that kind of thing.
Okay, so you've got these two camps. Both can profit depending on which way the market swings.
Exactly. Both have strategies that can work.
So where do the pigs fit in? Because it sounds like that's not about market direction, bullish or bearish. It's something else.
Precisely. The pig isn't defined by which way they think the market's going. It's about how they act once they're in a potentially winning position.
Ah, okay. So what happens?
Well, imagine a trader. They've made a good call, maybe caught a nice trend. Their profits are looking good. The pig is the trader who then gets excessively greedy.
Greedy how? Like just wanting more profit. Isn't that the point?
It is, but it's about taking it too far. They see those gains piling up and think, just a little bit more. They hold on way past a sensible point, hoping to squeeze out every last possible cent.
Okay, I see. They're reluctant to actually, lock in the win.
Exactly that. They want the absolute maximum.
But slaughtered is such a strong word. What's the real danger here? Why is it so bad?
Because markets turn. Always. An uptrend eventually pulls back, a downtrend finds a bottom and bounces. The pig, clinging on for dear life, gets caught in that reversal.
Ah. So those paper profits they were chasing just evaporate.
Evaporate. Or worse, turn into significant losses. They miss the window to take their gains off the table. And sometimes they end up losing more than they would have if they, just sat on the sidelines.
Wow. Okay. And you mentioned psychology earlier. This feels like it's deeply tied into that.
Oh, definitely. It's classic behavioral finance, really. Greed is a huge driver. But also fear specifically, the fear of missing out, FOMO, even on potential future gains you haven't banked yet.
Right. Like, what if it goes up another 10% after I sell?
Exactly. That thought process can completely cloud your judgment. You start ignoring your own strategy, maybe warning signs in the market, just because you're caught up in that emotional chase for more.
So it overrides logic, basically.
It really can. Instead of sticking to a predefined plan like, I'll sell when it hits X price, or I'll get out if it drops below Y, the pig is just flying by the seat of their pants, driven by that insatiable feeling.
Does this advice apply more to certain types of trading? Like, is it more for day traders or...
That's a good question. I think the core lesson is universal. It applies everywhere. But you could argue it's maybe more visibly destructive in faster styles.
like day trading or swing trading?
Yeah, precisely. Things move so quickly there. An opportunity to take profit can literally vanish in minutes or even seconds. So holding on too long is immediately punished.
But long-term investors aren't immune?
Not at all. It might look different, but it's the same root cause. Maybe they get overly attached to one big winner, let it dominate their portfolio, neglect diversification. It's still a form of greed or perhaps overconfidence, preventing prudent risk management.
It really sounds like finding a balance then. You need to aim for profit, obviously. That's why you're investing or trading.
Okay.
But it has to be tempered with, well, managing risk. Knowing when enough is enough.
That's the heart of it. Discipline, strategy. It's not just about the entry. It's equally, maybe even more about the exit. Having realistic targets.
So successful trading isn't really about hitting home runs every single time.
Not usually, no. It's more often about consistent, well-managed games. Suryawanshi's saying is a stark reminder that chasing those absolute peak profits often leads to disaster. Focus on the sustainable.
Okay, let's wrap this up. The key takeaway from Mansi Suryawanshi's bulls make money, bears make money, pigs get slaughtered seems clear.
Avoid that excessive greed.
Right. Whether the market's up or down, there are ways to profit. But if you let greed take over, if you become that pig holding on too long,
You risk losing it all, and then some. Knowing when to take your winnings and walk away, even if it's not the absolute top, is crucial.
yeah, crucial for staying in the game long term.
Definitely.
So a final thought for you listening. This principle of avoiding excessive greed, of knowing when enough is enough, where else does it show up? Think beyond finance. Ambition is good, but when does it tip over into something that could actually, cause you to stumble, something to mull over?
That's the question.
Thanks for joining us on the deep dive.